Picture this. It's a regular Tuesday morning in January 2026. You're scrolling through your phone, maybe checking Facebook, watching Instagram Reels, completely unaware that at that exact moment, Mark Zuckerberg is quietly filing paperwork to dump another $1 billion worth of Meta stock. Not 100 million, not half a billion, a full $1 billion. And here's what makes your stomach turn. He's been doing this almost every single week for months. By the time you finish watching this video, Zuckerberg will have offloaded more than $12 billion in Meta shares. That's not a typo, 12 billion with a B. To put that in perspective, that's more money than the entire GDP of some countries. That's enough to buy every single person in America a new iPhone. And he did it while telling you, telling investors, telling the entire world that Meta's AI future has never looked brighter. Now, I need you to understand something critical right now. This isn't about hating on Zuckerberg. This isn't some conspiracy theory cooked up in a basement. This is about recognizing a pattern that is played out over and over again in tech history, a pattern so predictable, so mathematically precise, that once you see it, you can't unsee it. And the scariest part, we're watching it happen in real time, and most people have absolutely no idea. Here's the thesis I'm going to prove to you over the next 15 minutes. When tech billionaires start selling massive amounts of stock while simultaneously pumping up their company's next big thing, they're not diversifying their portfolio. They're not buying a new yacht. They're running a playbook that's been used by every major tech company before a massive correction. Every single time, no exceptions. And right now, Meta is following that playbook page by page, line by line, word for word. Let me introduce you to what I call the four-stage extraction system. This is the framework that tech insiders use to cash out billions before reality catches up with the hype. Once you understand these four stages, you'll start seeing them everywhere. In every tech bubble, in every market correction, in every billionaire fire sale. Stage 1 is the narrative shift. This is where the company suddenly pivots from their current struggling business model to announce the next revolutionary technology. They don't just mention it in passing, they go all in. Every earnings call, every interview, every public appearance becomes about this one thing. For Meta, right now, the thing is artificial intelligence. Zuckerberg isn't talking about the metaverse anymore. Notice that? The thing he literally renamed his entire company for? Gone. Now it's all AI, AI, AI. Think of it like a magician's misdirection. While everyone's looking at the shiny new AI announcement, nobody's asking why Reality Labs just lost another $16 billion last year. Stage 2 is the insider liquidation. This is the critical phase. While the narrative shift is happening publicly, insiders start selling. Not all at once, because that would trigger alarms. They use something called 10b5-1 trading plans. These are prearranged schedules that let executives sell stock without it looking suspicious. It's completely legal, completely above board, and completely calculated. Zuckerberg filed his latest plan in September 2024. Within weeks, the selling accelerated. $1 billion here, $1 billion there, all while he's on podcasts talking about how AI is going to revolutionize everything. It's like watching someone sell their house room by room while telling buyers the neighborhood has never been better. Stage 3 is the institutional confusion. This is where Wall Street analysts start publishing contradictory reports. Some say buy, some say hold. A few brave souls say sell. The stock price becomes incredibly volatile. It swings wildly based on every single piece of news. Investors get whiplash, trying to figure out what's real and what's hype. And here's the genius part. This confusion creates the perfect cover for insiders to keep selling. Because when the stock is moving 15% in either direction every week, nobody notices the steady drip of insider sales happening behind the scenes. Stage 4 is the revelation moment. This is when reality finally catches up. The new technology doesn't deliver on its promises. The revenue projections fall short. The market suddenly realizes that the emperor has no clothes. And by the time regular investors figure it out, the insiders have already cashed out at the peak. They've converted their paper wealth into real assets. Real estate, treasury bonds, other investments. Meanwhile, regular people are left holding bags of stock that just lost 30, 40, sometimes 50% of its value. Pause. Now you might be thinking, okay, that sounds scary, but where's the proof? Show me this actually happened before. Great question. Let me take you back through 3 historical examples that will make your blood run cold. March 2000, the dot-com bubble is at its absolute peak. Cisco Systems is the most valuable company on planet Earth, not just in tech, on the entire planet. The company is worth $550 billion. Their CEO, John Chambers, is on the cover of every business magazine. He is telling everyone that Cisco is going to be the first trillion-dollar company. The internet is exploding. Everyone needs routers and switches. Cisco dominates that market with an 80% share. The future looks unstoppable. But here's the hidden detail most people don't know. In the 6 months leading up to March 2000, Cisco executives and board members sold over $4 billion worth of stock. Not after the crash, before it. They were on CNBC every week talking about unlimited growth potential while their trading accounts were lighting up with sell orders. John Chambers himself reduced his holdings by 42% during this period. The narrative they pushed was beautiful in its simplicity. The internet is growing exponentially. Every company on earth needs networking equipment. Cisco is the only player that can deliver at scale. They even created a new metric called pro forma earnings that excluded all the stock option costs, made their profits look massive. Wall Street ate it up. The stock hit a split-adjusted high of $82 per share, then April 2000 hit. Companies started canceling orders. Revenue growth that everyone projected didn't materialize. Cisco's customers were dot-com companies that were bleeding cash. When those companies started dying, Cisco's orders evaporated overnight. By April 2001, exactly 1 year later, Cisco's stock had crashed 76%. 76%. The company that was supposed to be worth $1 trillion lost over $400 billion in market value. But here's what keeps me up at night. John Chambers? He was fine. The board members who sold? They were fine. They'd already converted billions into cash. The people who got destroyed were retail investors who believed the narrative, people who trusted that if insiders were still holding, everything must be okay. Except the insiders weren't holding. They were selling the entire time. But that wasn't the worst part. The worst part was watching Chambers go on TV after the crash and act surprised. Shocked even. Like nobody could have seen it coming. Even though internal Cisco documents later revealed they knew about the order cancellations months before going public. They knew. And they kept selling. Let me take you to Houston, Texas. Summer of 2001. Enron is trading at $90 per share. The company has reinvented itself from a boring natural gas pipeline operator into a revolutionary energy trading platform. They're not just selling electricity anymore, they're trading it like stocks, creating markets for weather derivatives, bandwidth futures. They even tried to create markets for trading advertising space. Fortune magazine just named them America's most innovative company for the 6th year in a row. Jeffrey Skilling, the CEO, is on every channel explaining how Enron has unlocked a completely new business model. He uses phrases like asset-light strategy and intellectual capital. He tells investors that traditional metrics like cash flow don't matter anymore because Enron is creating future value through market making. Wall Street analysts are publishing price targets of $130 per share. Some even say $150. Here's the detail nobody talks about. Between January and August 2001, Enron executives sold $638 million in company stock. Kenneth Lay, the chairman, personally sold over $70 million. Lou Pai, who ran one of the divisions, sold $270 million, and literally bought a ranch bigger than some cities. These weren't small diversification sales. These were massive liquidations. And the whole time, they're sending emails to employees encouraging them to buy more Enron stock in their 401k retirement accounts. Internal emails, later recovered by investigators, showed executives literally laughing about employee loyalty while they were dumping shares. One email from August 2001 said, and I'm paraphrasing because I want to keep this clean, the employees have no idea what's coming. The narrative Enron pushed was genius because it was partially true. Energy markets were being deregulated, trading was becoming more sophisticated. There were real opportunities in creating new markets. The problem was Enron wasn't making money from any of it. They were hiding billions in losses through off-balance sheet partnerships, creating phantom revenue through mark-to-market accounting. The whole thing was a house of cards held together by narrative and hype. September 2001. The cards start falling. A Wall Street Journal reporter asks one simple question during an earnings call: can you explain how your trading operation actually makes money? Skilling can't answer. He gets defensive, angry even. Within weeks, the CFO is fired. By December, Enron files for bankruptcy.
The stock that was at $90 in August is worthless by Christmas. Completely worthless. 20,000 employees lose their jobs. Their retirement savings, all invested in Enron stock, evaporate overnight. But Ken Lay, Jeff Skilling, Lou Pai, they walked away with hundreds of millions in cash. They'd already sold. They'd already won. But that wasn't the worst part. The worst part was discovering that Arthur Andersen, supposedly one of the most respected accounting firms on earth, was shredding documents the entire time. They knew, the executives knew, the accountants knew. The only people who didn't know were the employees and investors who believed the story. September 2013. Elizabeth Holmes appears on the cover of Forbes magazine. She's wearing a black turtleneck, deliberately copying Steve Jobs. The headline calls her the next Steve Jobs. Her company, Theranos, is valued at $9 billion. She's a billionaire at age 29. Her technology promises to run hundreds of medical tests from a single drop of blood. No more vials, no more needles. Just a finger prick, and you get complete diagnostics in hours. Walgreens is putting Theranos testing centers in their stores. Safeway invested $350 million into a partnership. The board includes Henry Kissinger, George Shultz, and James Mattis, actual secretaries of state and defense. This isn't some Silicon Valley startup. This is a company with serious credibility and serious backers. Holmes gives TED Talks explaining how her technology will democratize healthcare. She says current lab testing is expensive, slow, and painful. Her Edison machines will change everything. She uses phrases like transformative innovation and paradigm shift. She's interviewed on every major network. President Obama appoints her a presidential ambassador for global entrepreneurship. Here's the hidden detail. Theranos never actually worked. Not kind of worked. Not worked with some bugs. Didn't work at all. The Edison machines couldn't run the tests. So what did they do? They ran patient samples on traditional lab equipment made by Siemens. Then they diluted the blood samples so much that the results were wildly inaccurate. People were getting false positives for diseases they didn't have, false negatives for diseases they did have. Lives were literally at risk. And the whole time this was happening, Theranos insiders knew. Tyler Shultz, George Shultz's grandson, was working there as an engineer. He saw the fraud firsthand. He tried to blow the whistle. His own grandfather didn't believe him because Elizabeth Holmes was so convincing. The narrative was so powerful that it overrode family loyalty. But here's where it gets dark. While Tyler is trying to expose the truth, Theranos executives are selling shares in private markets. Not to the public, because Theranos never went public, but to sophisticated private investors. Betsy DeVos bought in. Rupert Murdoch invested $125 million. These secondary sales happened between 2013 and 2015, while insiders absolutely knew the technology didn't work. October 2015. Wall Street Journal reporter John Carreyrou publishes his first investigation. The entire house of cards collapses within months. By 2016, Theranos is worth nothing. By 2018, Holmes is indicted on federal fraud charges. By January 2022, she's convicted and sentenced to 11 years in prison. But here's what haunts me about this case. It wasn't just retail investors who got burned. These were billionaires, experienced investors, people with access to due diligence teams, and they still fell for the narrative because Holmes was that good at selling the story. But that wasn't the worst part. The worst part was learning that patients who received false test results didn't even know for years. Some made medical decisions based on bad data, started medications they didn't need, missed diagnoses they should have gotten. The human cost of the narrative was immeasurable. Now let me bring you back to today, February 20th, 2024. Meta reports fourth quarter earnings. The stock jumps 20% in a single day. 20%. Mark Zuckerberg announces that 2024 is going to be the year of efficiency and AI. He says Meta is going all in on artificial intelligence. He talks about Llama 3, their open source AI model. He mentions AI-powered ads that will revolutionize digital marketing. Wall Street loses its mind with excitement. But here's what happened behind the scenes that same week. Zuckerberg filed an updated 10b5-1 plan to sell even more stock. The plan was dated February 15th, 5 days before the earnings call. Think about that timing. He knew exactly what he was going to announce. He knew the stock would spike, and he set up the perfect mechanism to sell into that spike. March through November 2024, Zuckerberg sells consistently. Some weeks it's 800 million, some weeks it's 1.2 billion. The sales are so regular you could set your watch to them. Every SEC filing shows the same pattern. Automatic sales, pre-arranged plans, completely legal and completely calculated. Now let me show you the narrative versus reality breakdown. On earnings calls, Zuckerberg says Meta is investing heavily in AI infrastructure. True, they're spending billions on NVIDIA GPUs, building massive data centers. But here's what he doesn't emphasize. Reality Labs, the metaverse division he bet the company on, lost $16 billion in 2023 alone. That's billion with a B. And in 2024, it's on track to lose another $17 billion. Think about that math. Meta is hemorrhaging over $15 billion a year on a product that almost nobody uses. Horizon Worlds, their flagship metaverse platform, has fewer than 200,000 monthly active users. That's less than some random mobile games. But instead of admitting the metaverse pivot failed, Zuckerberg just shifted the narrative to AI. Here's the smoking gun evidence. Internal Meta documents leaked in September 2024 show that AI-generated revenue is growing much slower than projected. Their AI ad targeting isn't dramatically outperforming traditional methods. The Llama models are impressive technology but aren't generating meaningful revenue yet. Meta's actual AI business, as of late 2024, represents less than 3% of total revenue. But if you watch Zuckerberg's interviews, you'd think AI is already transforming the entire company. He went on Lex Fridman's podcast in January 2025 and spent 2 hours talking about AI alignment, AI safety, AI infrastructure. He barely mentioned Reality Labs, barely mentioned the billions in losses. It's pure narrative control. Now here's what mainstream media is completely missing. They're reporting Zuckerberg's sales as normal diversification. Bloomberg ran a headline in October 2024 that said, Zuckerberg sells stock to fund philanthropy. That sounds nice, right? Except when you dig into the Chan Zuckerberg Initiative's recent investments, they're not going to malaria research or education. They're going into real estate and private equity. He's converting Meta stock into hard assets. If you pulled up a chart right now comparing insider sales to public statements, the correlation is stunning. Every major AI announcement is followed within days by increased selling. When Meta announced Llama 3 in April 2024, Zuckerberg sold $900 million that week. When they announced AI Studio in July, another $1 billion in sales. The pattern is mathematical. And here's the institutional confusion part playing out exactly as predicted. Morgan Stanley has a buy rating with a $650 price target. Goldman Sachs says hold. Citron Research published a short report in November calling Meta's AI narrative overblown. The stock swings between $450 and $620 throughout 2024. That volatility, perfect cover for selling. Let me show you the deeper pattern. Meta's price to earnings ratio in late 2024 is around 25. That sounds reasonable until you realize the earnings don't include the Reality Labs losses properly. If you actually subtracted those losses from core business profits, the real PE ratio would be closer to 40. The stock is priced for massive AI growth that hasn't materialized yet. Now check this out. In December 2024, Meta announced they're spending up to $40 billion on AI infrastructure in 2025. $40 billion. That's more than most countries spend on their entire military. Zuckerberg is telling investors this spending is necessary to stay competitive. But here's the question. Nobody's asking. If this investment is so critical, so game-changing, so certain to pay off, why are you personally selling $12 billion worth of the stock? That's the contradiction that should make your alarm bells ring. If I told you I was opening the greatest restaurant ever conceived, and the food was going to be revolutionary, and we're going to expand to 1,000 locations, but also I'm selling my ownership stake as fast as legally possible, would you invest? Of course not. You'd recognize the mismatch between words and actions. October 2024 brought another revealing moment. Meta's AI division announced they're open sourcing most of their AI research. Sounds generous, right? Except open sourcing means you're not planning to monetize it directly. You're giving it away. Now, why would you give away technology you claim is worth billions unless you don't actually have a clear path to monetization? Compare that to OpenAI. They're keeping GPT models proprietary. They're charging for access.
They have a clear business model. Meta is doing the opposite. They're open sourcing Llama while claiming AI is their future. The strategy doesn't match the narrative. Here's another smoking gun. LinkedIn data from late 2024 shows Meta laid off over 20,000 employees since 2022. The metaverse teams? Gutted. The Reality Labs division? Massive cuts. But AI teams? They're actually not growing that fast either. If AI was truly the revolutionary opportunity Zuckerberg claims, you'd expect massive hiring in that division. It's not happening at the scale you'd expect. Now let me tell you about the ad business, because that's where this gets really interesting. Meta's core revenue still comes from Instagram and Facebook ads. If the business is mature, growth is slowing. In Q3 2024, ad revenue grew 11% year over year. That's decent, but not explosive. The AI-powered ad targeting they keep promoting? It's incrementally better than previous algorithms, but not dramatically so. Advertisers I've talked to say the improvements are marginal, maybe 5 to 8% better performance, not the revolutionary change Meta claims. So we have a situation where the core business is slowing, the metaverse bet failed catastrophically, the AI narrative is overblown, and the founder is selling stock faster than any point in company history. Does that sound like a man who's confident in his company's future? Or does it sound like someone who's read the playbook and knows exactly what comes next? Now, I can hear some of you thinking, but this time is different. Zuckerberg is still the majority voting shareholder. He controls Meta no matter how much stock he sells. That's absolutely true. He owns enough super voting shares that he could sell 90% of his economic stake and still control the company. So the objection goes, if he's still in control, the selling doesn't mean he's bearish on the company. Here's why that objection misses the point. Zuckerberg doesn't need to be bearish on Meta long-term to recognize that the stock is overvalued right now based on AI hype. He can believe in the company's future while also understanding that the current $600 stock price is pricing an AI success that hasn't happened yet. So he's harvesting that overvaluation while he can. Think of it this way. If you owned a house that you loved and planned to live in forever, But your neighbor just sold their identical house for triple what it's actually worth because buyers think the neighborhood is about to boom. Would you cash out some equity? Of course you would. That doesn't mean you hate your house. It means you recognize temporary overvaluation. Second objection. Meta is actually making real progress in AI. Llama models are legitimately impressive. That's also true. Meta's AI research is world-class, but impressive research doesn't automatically translate to billions in revenue. IBM has incredible AI research. Their stock has gone nowhere for a decade. Google has been doing cutting-edge AI work for years. Their stock trades at a lower multiple than Meta. Technical capability and business value aren't the same thing. The question isn't whether Meta can build good AI models. The question is whether they can monetize those models at a level that justifies the current stock price. And right now, the answer is no. They're giving most of it away for free through open source releases. Third objection. Zuckerberg just needs cash for personal reasons. He's building a compound in Hawaii. He's funding Chan Zuckerberg Initiative. $12 billion is a lot, but he's a very rich man with expensive projects. Fair point. Except when you look at the timing, this objection falls apart. Why didn't he sell $12 billion in 2020 when Meta stock was at $300? Why didn't he sell in 2021 when it hit $380? Why wait until 2024 when the stock is pumped up on AI hype? The timing isn't random, it's deliberate. He's selling into strength after creating a narrative that pushed the stock higher. And here's the thing that should bother you most. Zuckerberg isn't talking about these sales. He's not explaining them in interviews. He's not addressing them on earnings calls. They just happened quietly in SEC filings that most people never read. If the sales were truly innocent diversification, why not just say so? Why the silence? Let me summarize this entire pattern in one sentence. When tech founders sell billions in stock while promoting the next big thing, they're not diversifying. They're extracting value before reality catches up to narrative. You've now seen this play out with Cisco and the internet boom, with Enron and energy trading, with Theranos and blood testing, and you're watching it happen in real time with Meta and artificial intelligence. The playbook never changes. Only the technology narrative changes. So what do you actually do with this information? First, if you own Meta stock, you need to seriously evaluate whether you're holding because of fundamentals or because of narrative. If your thesis is that AI will transform Meta's business, ask yourself what specific revenue that AI is generating today. Not in theory, not in 5 years. Today. If the answer's unclear, you might be holding narrative instead of value. Second, look at your entire portfolio through this lens. Do you own other stocks where insiders are selling heavily while promoting new initiatives? NVIDIA insiders were selling throughout 2024 while talking about AI chip demand. Salesforce executives sold billions while pivoting to AI. This pattern isn't unique to Meta. It's happened across big tech. Third, create a simple system to track insider sales. The SEC has a free Edgar database where every insider transaction is reported. Set up alerts for companies you own. If you see sustained selling over multiple quarters, especially by founders and C-suite executives, treat it as a yellow flag. Not a guaranteed sell signal, but a reason to dig deeper. Fourth, separate impressive technology from profitable business models. If AI is real, it's powerful. It's going to change industries. But that doesn't mean every company claiming to do AI will make money from it. Most won't. The companies that win will be the ones with clear monetization paths, not the ones with the best press releases. Fifth, remember that these billionaires have information you don't. They see internal metrics months before they're public. They know which initiatives are working and which are failing. When their actions contradict their words, trust their actions. People lie, money doesn't. Between now and the end of Q1 2025, I want you to do this. Pull up Meta's stock chart. Mark every major AI announcement Zuckerberg has made, then overlay insider selling data from SEC filings. You'll see the pattern with your own eyes. When you see it clearly, you can't unsee it. Now here's my promise to you. Part 2 of this investigation drops next week, where I'm going to reveal the 3 companies that are next in line for this exact pattern. I've already identified the warning signs, the insider selling has already started, and the narrative shifts are happening right now while you're watching this. If you think Meta's situation is concerning, wait until you see what's brewing at these other companies. But here's what I need you to understand before we end this. I'm not trying to scare you. I'm trying to prepare you. The market rewards people who can distinguish between real value and manufactured narrative. Right now, we're in the largest AI hype cycle in history. Trillions of dollars are being invested based on promises and potential. Some of those investments will pay off spectacularly. Most won't. The people who will win are the ones who can see the pattern, who can recognize when insiders are extracting value, who can separate the signal from the noise. You now have that framework. You've seen it play out across decades. You know the 4 stages. You know what to look for. The question is, what will you do with this knowledge? Will you ignore it because it's uncomfortable? Will you rationalize it away because you want to believe the hype? Or will you use it to protect yourself and potentially profit when reality reasserts itself? Mark Zuckerberg has sold $12 billion in Meta stock over the past year. That's not a conspiracy, that's a fact. He did it while telling you AI is revolutionizing his company. That's also a fact. The gap between those two facts is where your opportunity lies. Don't forget to check the description below. I've linked every source, every SEC filing, every data point I mentioned in this video. Verify everything yourself. Don't trust me. Trust the pattern, trust the math, trust what insiders do with their own money. And if this video made you think differently about tech investing, hit that subscribe button. Part 2 is going to expose something even bigger. Something that connects Meta's selling to a broader market pattern that most analysts are completely missing. You're not going to want to miss it. Remember, in markets and in life, the biggest opportunities come from seeing what everyone else is looking at, but not actually seeing. You just saw it. Now act on it.